Welcome back to the deep dive. Our mission here is to cut through all the noise, bypass the jargon, and really give you the essential heart-won knowledge you need to be informed on the topics shaping industry today.
And today, we are diving deep into a subject that, just a few years ago, was promised as the savior of global supply chains: blockchain.
Oh, absolutely. If you went to any conference back in, say, 2018, you would have thought that by now every single shipping container was moving with this perfect, immutable digital history.
It was the future, fully realized.
Oh, sure.
Or so they said.
But when you actually look at the reports, the reality is, well, it's a lot more painful. Our sources point to this stunning disconnect between the promise and the business reality.
Yeah, Gartner famously predicted that 90% of these blockchain supply chain projects would suffer from blockchain fatigue by 2023. Basically an industry-wide burnout.
And 90% feels, I don't know, a little low now, doesn't it?
It might have been optimistic. Independent analysis suggests the actual failure rate is well and truly upwards of 95%.
95%. Think about that. So when you have a technology designed specifically to solve trust and transparency, and it fails almost every time, the problem can't be a bug in the code.
Exactly. It's not about the blockchain itself.
It's a human problem.
It's a human problem hiding under a tech label. The failures, they almost always come from organizational friction, bad governance, flawed incentives, and just this unwillingness of fierce competitors to actually collaborate.
Okay, let's unpack all of that. So if you're listening today, maybe you're a logistics pro, supply chain manager looking at a big digital project, or you're just curious why big tech promises so often fall flat, you need to know where these pitfalls are.
Right. And our mission today is to move you past all the buzzwords, the distributed ledgers, and cryptographic hashing, and focus on the real factors that separate success from, well, very expensive failure.
Before we get into the failures, maybe we should just briefly define the tech itself.
Good idea. At its core, blockchain is just an immutable, decentralized ledger. It's not magic. It's really a clever mix of existing concepts. You have cryptographic hashing, which is sort of like a unique digital fingerprint for data.
A digital seal.
A perfect way to put it. And then you have digital signatures to prove who did what, and this whole peer-to-peer network to make sure everyone agrees. The result is a system that can provide secure transactions and prevent fraud. The technology is capable.
It can work, but we're going to show you why having perfect tech doesn't matter if the business agreement, the governance, is just fundamentally broken.
So here's our roadmap. First, we'll do an autopsy of the biggest failure story out there: TradeLens.
Then we'll get into the fundamental data problem, this idea of garbage in, immutable garbage out.
After that, we pivot to what's actually working in 2025, the utility model.
And finally, we'll leave you with a clear, actionable checklist for managers to decide if you even need blockchain in the first place.
All right, let's start with the big one, the spectacular and frankly incredibly expensive failure of TradeLens. And this wasn't some small startup, playing around in a garage. This was a joint venture between Maersk, the world's largest container shipping line, and IBM, a global tech giant.
Launched in 2018 with huge fanfare, seemingly unlimited resources.
And their ambition was just colossal.
Yeah.
They wanted nothing less than full end-to-end digitization of global maritime logistics.
An industry that's, it's famously slow, right? It's all paper-based, prone to errors, disputes.
Exactly, all of which means huge delays and massive costs. TradeLens promised to replace all of that with a single, unalterable digital system.
And we have to say it again. The technology was good. The architecture they built proved that a blockchain system could solve these complex cargo tracking problems.
The tech worked. Smart contracts could automate things like customs. The records were tamper-proof. But it failed to get traction, and Maersk shut it down in late 2022.
So what went wrong? The first problem was just simple economics, wasn't it?
It was. The high development cost translated directly into a high price for customers.
So people looked at the fees, compared it to their current messy but working paper system, and just said, no thanks.
Pretty much. We saw industry figures confirm this. One expert from the Port of Barcelona said customers wanted better traceability, sure, but they were not willing to pay such a high additional cost.
They just wanted a flat fee, something cheaper.
Right. The value just didn't match the investment required.
Okay, so the price was too high. But there was a deeper problem, wasn't there? The platform failed to convince the people whose data it actually needed.
This is such a critical point. A blockchain is only valuable if it gets critical mass. If the port terminals, the freight forwarders, if they find the value in providing their data is very low, and they're not getting compensated for it, why would they join?
It feeds that whole critique that blockchain was this excessive, expensive, cumbersome, and unnecessary burden for a lot of these companies.
It does. But let's dig into the real poison pill here. This is what we call the trust paradox.
The fact that TradeLens, while the tech was neutral, was owned by Maersk.
Owned and driven by Maersk. And Maersk isn't just another player. It's a dominant rival to everyone else. MSC, CMA, CGM, you name it.
And this is the core lesson, right? The second a competitor owns the infrastructure, you've introduced a fatal flaw.
You're asking your rivals to willingly weaken their own competitive advantage.
You're asking them to hand over their business intelligence to the biggest kid on the playground.
That's it, exactly. Think about what that data is. It's not just a tracking number. It's how efficiently you use your ships, your freight rates, your profitability on a specific route.
So if I'm MSC and I give you that data, you suddenly get insight into my most profitable lanes, my cost structure.
It gives them the data to undercut you. They can see where you're making money and focus their competition right there. It's basically handing over trade secrets.
And the idea of making the data anonymous, that wasn't enough, was it?
Not at all. In logistics, you can often figure out who's who just based on the type of commodity, the specific ports, the volume. True anonymity is almost impossible.
So what happened?
Competitors, logically, chose to protect their data sovereignty.
Data sovereignty, so the right to control your own data.
Yes. The competitive conflict in the ownership structure meant that major players were just flat out unwilling to collaborate openly.
And that hesitation was what sank the whole thing.
It was the anchor. It prevented TradeLens from ever reaching that critical mass it needed to be useful.
Yeah.
In these global platforms, you need, 80–90% adoption to really work.
And the governance model just never provided the neutrality to get there.
It showed that perfect tech and huge funding mean nothing if you fail to solve the core human and competitive reality of the market. You have to earn trust. You can't just buy it.
But couldn't Maersk have just, subsidized it? Pushed it so hard that it became the standard and forced everyone else to join?
That's a great question, but it hits another wall. Antitrust laws. A dominant carrier pushing a proprietary system that gives them access to competitor data. That would raise massive regulatory red flags.
And competitors could just launch their own thing.
Which they did. They created rival consortiums, which just fragmented the market even more. It proved that even a giant can't dictate a standard if it means everyone else has to sacrifice their competitive intelligence.
So, lesson 1 from TradeLens. If the players are rivals, the governance has to be neutral, or the platform is dead on arrival.
Exactly. And that brings us from organizational failure to the technical Achilles heel that plagues every single one of these systems, even the ones with perfect governance.
This is what we're calling the garbage in, immutable garbage out problem.
It is. It's the operational disconnect, the point where this beautiful, pristine digital ledger has to touch the messy physical world.
Right, because the technology itself, the math, it works perfectly inside its own digital bubble.
Flawlessly. Transactions are verified, secured, time-stamped. It's beautiful. But the problems start the second the chain needs data from the real world. This is often called the oracle problem.
The oracle problem, getting reliable real-world data onto the secure ledger. Because the chain can't see or hear, right? It just records what it's told.
Correct. The integrity of that whole immutable ledger depends entirely on the quality of the initial input. And that input can fail in, well, 2 big ways.
First, humans.
Humans. We make mistakes. A worker scans the wrong box, either by accident or, intentionally to commit fraud. A broker types in the wrong tariff code because they're in a rush.
And second, the sensors themselves. IoT devices can malfunction, batteries can die.
Exactly. A sensor could record a temperature spike that never actually happened. And this is where blockchain's biggest strength, immutability, suddenly becomes its biggest weakness.
Because if that worker scans the wrong box,
that error is permanently recorded. It's there forever.
Whereas in a normal database, you just go in, find the mistake, and hit delete or update.
But on a blockchain, you can't. The original incorrect record is always visible. Now, you can add a new transaction to say the old one was wrong, but now you have 2 entries, the garbage and the correction.
Which sounds like a nightmare for auditing. You're just creating more work.
It undermines trust in the whole system. So the bottom line is, the ledger is completely useless unless the data it records is trustworthy before it gets written.
So the solution is creating a reliable physical digital handshake. You have to remove the human error as much as you can.
That's it. That handshake means integrating trusted, non-human data sources. Secure IoT sensors, telematics, that can prove the data came from an authorized device at a specific time and place.
So you get real-time recording of temperature, location, humidity, shock events,
Yeah.
all going straight to the ledger.
It dramatically reduces the human element. We saw Deloitte do a proof of concept on this. They used Hyperledger Fabric, which is a popular enterprise blockchain, and combined it with real-time trackers.
And what was the result?
They built a trusted history of the shipment. It streamlined tracking for everyone involved, and more importantly, it helped the client cut costs on regulatory reporting because the data was so easily auditable. The system could prove, without a doubt, where the package was and what condition it was in.
That's huge for regulated industries.
It is. We see it in pharma, too. A company called Modem.io tracks sensitive things like temperature-controlled medicines. They use a combination of IoT, blockchain, and AI to make sure that physical data is captured and secured in a way that satisfies regulators and insurers.
And you mentioned AI. That's a perfect gatekeeper, isn't it?
It's the gatekeeper. You can train AI and machine learning models on the historical data that's already on the blockchain, the good, trustworthy data. Then, when new data comes in from a sensor, the AI can spot anomalies in real time.
So if a sensor on a refrigerated container in the Arctic suddenly reports a 100-degree temperature, the AI flags it as probably a malfunction before it gets written to the permanent record.
Precisely. This integration ensures that only the most accountable, verified records actually make it onto the chain. It drastically reduces the chances of having immutable garbage. It's essential for building trust in the digital record itself.
Okay, so we've established two big things. First, bad governance and trust issues killed the big for-profit models like TradeLens. And second, the system is useless without a solid link to the physical world through things like IoT and AI.
Right.
So the big question is, if that heavily funded commercial model failed so badly, what kind of model is actually working now in 2025?
Well, the evidence shows this massive, necessary pivot away from that old architecture. We're seeing a clear shift from the failed for-profit model to the successful utility consortium model.
A utility model. So you're saying the key is to prioritize adoption over profit.
Yes, it seems like a radical idea for an industry like shipping, but that's exactly it. To succeed, the platform itself can't be a profit center. It needs to be a shared cost center, a piece of infrastructure that everyone uses.
So if the platform is supposed to be the single source of truth for a bunch of competitors, it has to be governed by those competitors, not owned by one of them.
That's the realization the market came to. And the best example of this working right now is the Global Shipping Business Network, or GSBN.
What's their secret?
GSBN was formed by carriers and terminal operators, and it operates on the belief that you need a non-profit infrastructure to allow for neutral data exchange. That neutrality is the secret sauce TradeLens never had.
How does that play out in the real world?
The CEO of GSBN has said they have zero commercial incentive to steal business from anyone building apps on their platform. This is critical. So if some startup builds a brilliant app for, say, electronic bills of lading, GSBN won't turn around and build a competing one.
Their job is just to provide the rails.
Just the secure, transparent data rails for that app to run on. It completely eliminates the trust paradox. If the network owner is a neutral utility instead of your biggest competitor, you're much more likely to join and share your data.
And we're seeing this same idea in the pharmaceutical industry with the MetaLedger Consortium, right?
Exactly. They were set up to solve the U.S. Drug Supply Chain Security Act, which requires track and trace for prescription drugs. The stakes there are incredibly high. Counterfeit drugs are a massive problem.
But the big pharma companies are just as competitive as the shipping lines. So how did MetaLedger solve that data privacy issue that killed TradeLens?
They used a really clever piece of tech that managers need to know about. Zero Knowledge Proof Technology, or ZKP.
Zero knowledge proof. Okay, break that down for us.
So think of it like this. ZKP lets you prove a statement is true without revealing any of the secret data you use to prove it. The classic analogy is proving you're over 21 without showing the bouncer your actual birth date. You prove the fact, not the data.
So in logistics, a carrier could prove a container number is authentic and belongs to them without revealing what's inside it or what they charged the customer.
That's it exactly. ZKP technology hides the sensitive details of the transactions on the ledger, so you get 100% privacy. It prevents that leakage of business intelligence while still giving you the immutability and verification you need from the network.
That's an elegant solution. It solves the trust problem with a technology solution.
And MetaLedger also made sure the governance came from the industry itself. By making the infrastructure neutral, confidential, and industry-led, they got the collaboration that TradeLens could only dream of.
So let's talk about the one use case that is having huge success right now, the electronic bill of lading, or EBL.
The EBL is the perfect fit. It's successful because it focuses on one specific, high-value, paper-intensive document, the bill of lading, instead of trying to, overhaul an entire company's operations at once.
And the traditional paper bill of lading, it's basically the title deed for the cargo. And moving that piece of paper around the world has always been a huge bottleneck.
It's the ultimate pain point. You have a multi-million-dollar ship in port, but the cargo can't be released until a specific piece of paper arrives by courier. If that paper gets lost or stained with coffee, that cargo just sits there, racking up huge fees.
And the costs are staggering.
Oh yeah. The World Economic Forum estimates documentation is up to a fifth of total transport costs. That's a massive amount of money tied up in just waiting for paper.
So what does the data say about the move to EDLs?
The adoption numbers are really compelling. A 2024 survey showed the incorporation rate of EBLs jumped from 33% in 2022 to nearly 50% in 2024. And almost three-quarters of the companies still on paper plan to switch. That's real momentum.
And the benefits are clear to the users.
Absolutely. They point to faster processing time, major cost savings, and way better security. It just eliminates the fraud risk you get with easily forged paper.
You mentioned a real-world milestone with Colombian Customs.
Yes, this is huge. Colombian Customs now officially accepts EBLs through the GSBN app. This is an application running on those neutral GSBN rails we talked about.
And what does that mean for a customs officer on the ground?
Radical efficiency. Instead of a stack of papers, the officer just scans a QR code on a PDF. That scan instantly checks the document's authenticity against the data on the blockchain.
So instant verification, fewer manual checks, and much lower fraud risk.
It sets a powerful precedent for global paperless trade. And again, the key is the neutral platform GSBN, combined with the immutable document on the blockchain. It passes the governance test and the traceability test.
Okay, this brings us to the most practical part of this deep dive. For any manager listening, looking at all the hype, the successes and the failures, how do you decide if your project actually needs a blockchain?
We need a clear framework. And it has to start with the one question that should probably kill 9 out of 10 blockchain pitches right away.
Which is?
Do you just need a better database?
Because the answer is almost always yes, unless you're missing one key ingredient.
And that ingredient is trust, or a lack of it. If all the participants already trust a central party, and data sharing is cooperative, then a good distributed database is way cheaper, faster, and easier.
So if I'm just trying to manage inventory between my own warehouses, I need an ERP system, not a blockchain.
Correct. Traditional systems are fine when you have a centralized ownership and trust. Blockchain's real utility only kicks in when you have to bridge that trust gap between external partners, competitors, customers, and regulators.
So let's formalize that. Here's our 3-point checklist. First up, is lack of trust the core problem? We'll call this the governance test.
The criterion here is simple. You need many distributed participants who are inherently skeptical or competitive rivals. Think back to TradeLens. If your network needs a neutral, peer-controlled system to convince rivals to even join, then blockchain is a good fit.
So the decentralized control is the key feature.
Right. In a good consortium, all the major players run their own nodes, their own servers that validate transactions. This distribution of power means no single actor has full control. The governance is peer-based.
The takeaway for a manager.
If the competitive landscape demands a shared neutral infrastructure, look at blockchain. If everyone already trusts the central operator, just stick with the standard database. It'll save you a fortune.
Okay, number 2 on the checklist. Is regulatory or life or death immutability required? This is the traceability test.
The criterion for this one is the use case involves legal documents or high-stakes tracking where fraud is a huge risk.
Like the bill of lading or tracking pharmaceuticals.
Exactly. These things need a cryptographically secure, irreversible chain of custody. It's critical for complying with standards like the DSCSA or proving authenticity for luxury goods.
And a standard database audit log isn't good enough.
It can be altered, a central authority could change it, or a sophisticated hack could compromise it. Blockchain's architecture, where every transaction is linked to the previous one across a distributed network, makes tampering practically impossible without the whole network noticing.
So the takeaway, if compliance requires absolute non-repudiable proof of history, blockchain is a huge advantage.
And that brings us to number 3. Does the workflow require trustless automation? The smart contract test.
This is all about efficiency and automation.
Right. The criterion is, the goal is to eliminate disputes and manual errors in complex multi-party agreements. Think about all the reconciliation that kills efficiency in trade.
Verifying cargo arrival, customs clearance, releasing payments.
Perfect examples. If you're dealing with processes that are manual and prone to dispute, you need smart contracts. These are programmable, self-executing contracts built right on the blockchain.
What's the ROI on something like that?
It can be massive. Smart contracts can speed up payment cycles by as much as 70% because the verification is instant. We've seen trade finance projects where reconciliation time was cut by 48%.
And what specific tasks get replaced?
Think about calculating demurrage, the fines for a container staying too long at port. That's always disputed. A smart contract can use trusted IoT data to automatically calculate the time and trigger the invoice. No more back and forth.
So if cutting out intermediaries and manual reconciliation is key to your ROI, smart contracts on a blockchain are necessary.
That's the short version. If your problem involves competition, high regulatory risk, and high manual costs across skeptical parties, that's the sweet spot for blockchain. If you just need better internal inventory management, use an ERP. #outro. So, to summarize the deep dive, the central failure point of all the blockchain hype wasn't the technology, it was organizational.
It failed to get critical mass because of legal issues, the unwillingness of rivals to collaborate, and most of all, a lack of trust in the governance model.
And the market has corrected. The models that are thriving now, like GSBN and MetaLedger, prioritize neutrality and confidentiality over commercial exclusivity. They solve the human problem first.
Which brings us to our final provocative thought. For the manager designing a new system, the benefits of transparency don't come for free. There's a significant computational and environmental cost.
Right. The original consensus mechanisms, like proof of work, which Bitcoin uses, require a massive amount of energy to secure the network.
So when you're choosing a chain, you have to weigh that impact against the benefits.
Absolutely. And most successful enterprise chains are avoiding proof of work. They're opting for less resource-intensive alternatives.
Like proof of stake, where validation is based on collateral, which is way more energy efficient.
Or even more common in these private enterprise settings, proof of authority, where a few pre-approved, trusted participants handle validation. It dramatically cuts the computational cost.
So the choice of consensus mechanism is a huge part of the project's viability and responsibility.
But here's the final, deeper challenge. There's a double-edged sword to all this efficiency.
How so?
Well, while optimizing a local process, like reducing truck queues at a port, might cut CO2 emissions there, the global economic acceleration that comes from blockchain could actually increase the overall volume of international trade.
Meaning, if trade becomes 70% faster and 40% cheaper, businesses will just trade more, which could increase the overall global demand for shipping and production.
The challenge, then, isn't just picking the right governance model. It's ensuring your technology choice is environmentally and financially responsible, and that the gains in transparency truly justify the full cost of accelerating global commerce.
It forces you to look beyond your own supply chain and consider the macro impact of efficiency itself.